Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He is not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thank you very much, Carolyn. Every month, we look at the latest economic data to see what they can tell us about the current state of real estate markets and where they might be headed. Our underlying premise is that you make better investment decisions when you have a better idea of the economic forces that affect supply and demand. This month, I want to focus again on the home price bubble. New data show very clearly that the surge in home prices is over, finally killed by higher mortgage rates. I happen to think the bubble would have ended pretty soon anyway, but the quick effect of the higher interest rates is a clue to what will come next. Here's one way to look at home prices. This chart shows the increase in prices each quarter compared to the same quarter of the previous year. In the third quarter of this year, sales prices were 16% higher than in the third quarter of last year. Prices at that time were already 17% higher than the previous year. So we're looking at a total increase in prices of almost 35% in 2 years. The value of charting prices this way is that it gives you a pretty good idea of what will happen next. I'll be very surprised if the increase for the fourth quarter isn't somewhere down around 10%. Here's another way to look at the same data. This time we see the increase in prices every quarter compared to the previous quarter. For years, the increase was bumping around between 1 and 2% until the third quarter of 2020, when a sustained rise in prices began. In the most recent quarter, the increase is back below 2%. Now the bubble is over. Our worry is about what will come next. This chart shows what happened after the previous home price bubble peaked, starting in 2005. At that time, we saw a gradual slowing of price increases and then years of falling prices that continued well after the 2008 recession was over. There's a pretty good argument that the end of price increases at that time actually caused the 2008 recession rather than the other way around. But in any case, I think we'll see a much faster resolution of prices this time. The fact that higher mortgage rates could so quickly dampen demand this year means that the demand was fairly thin all along. So the effect on prices will happen much more quickly. By the way, our forecasting model, which incorporates a lot of the dynamics from the price bust we're looking at here, says that home prices next year will still be almost 10% higher than this year, but I don't really believe it. At best, I think prices next year will be flat, and in many local markets will be down. How much they'll be down depends very much on how much growth we get from the economy, so let's look at that next. Here's our best short-term way to look at the economy, the growth of jobs. On the left, in this chart in blue, and up to the end of 2021, is the loss of jobs since the pandemic began. On the right, in red, is the growth of jobs since then. The encouraging sign is the good growth rate in recent months, around 3% a year. The slightly worrisome aspect is that the rate of growth dropped a bit in November. And compared entirely to the level of jobs before the pandemic, the situation is also unclear. Yes, we now finally have more jobs at that time, but the rate of growth is pretty small. So a look at the major sectors of the economy could tell us much more about this story. In healthcare, the rate of job growth is picking up rapidly after sharp pandemic losses. In government, on the other hand, it's clear that the current weak rate of growth won't make up for the large number of government jobs that were lost. Restaurants are recovering more of the lost jobs. And the retail sector continues to add jobs, even though at a modest rate. But these very consumer-oriented sectors remind us that the US population is growing at a much slower rate than it used to. And we won't know for a while how the pandemic has affected the birth rate, which is key to future growth. The manufacturing sector also had hiccup in November. And more importantly, so did the very large business services sector, which is the main engine of the economy right now. One of the reasons for slower growth in business services is lesser use of temporary workers, which means businesses are cutting back expenses. If growth in business services is again slower in December, it will be an ominous sign for the economy in 2023. On the brighter side, the cost of energy has come down in recent months. Whether or not this is due to slower demand around the world, it means that inflation is likely to ease. That's it. In this time of uncertainty, let me plug our Investors Metro analysis, which analyzes home prices and rents, calculates investment risk, and provides strategic investment analysis for each local zip code. Available for 200 markets, it's written for investors, not economists. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.